Despite the low interest rates of the past decade, insurers still have managed to grow capital through de-risking activities, as well as the repricing and revamping of products. But these low interest rates, along with rising equity markets, are not a given. And now interest rates are on the move, and for insurers, the pace of such hikes matter. Here to discuss these dynamics is Meg Mulry, an associate director and senior economist, and Jason Hopper, an associate director in AM Best Industry Research and Analytics Department. And Meg, looking back 35, 40 years, interest rates were topping out around 15% or so. Obviously, we're nowhere near that today. But are there any similarities in the environment between then and now?
Yeah, obviously we've had very easy monetary policy for a while here. We're nowhere near 15%. At that time, the Federal Reserve was looking to tackle inflation, which was running in excess of 10%. So they made a number of very steep increases in the interest rate. That's the concern that the markets have right now. How fast are they going to increase? Right now, inflation is not a concern. PCE, which is the preferred metric for the Federal Reserve, came in at 1.9% last month, which is right about on target of the 2% level that the Federal Reserve is looking for. So as a result, they have said, we are going to continue our moderating increases. We're looking for 2 to 3 rate increases this year. Obviously, it'll remain data dependent. The concern for the market is obviously the inflation readings. And there are a couple of things that they're keeping an eye on. First, the labor markets. Unemployment fell to 3.9% last month, and that's the lowest it's been since 2000. Labor markets are very tight. We are seeing inflation kind of creep into wages, which is a positive overall as long as it doesn't get ahead of itself. Oil has started to move, geopolitical concerns with Iran, as well as supply constraints that OPEC has been putting in, as well as Russia, have started to move oil higher. These are some of the things that we'll keep an eye on and that will drive inflation. But as of right now, we're not seeing these huge increases that we have seen in the past.
Jason, what are some of the considerations for insurers should we see a sudden spike in interest rates?
So there are quite a few considerations that insurers need to be wary about in today's environment and going forward in the near term. First, to kind of set the stage, at our AM Best Review Preview Conference a couple months ago, we had issued an audience-based survey asking what members thought the interest rates would be at year-end 2018, and over half of the responses stated that they thought rates would be above 3%, a somewhat sizable shift from where they are today. Companies have been doing a very good job over the past 10 years de-risking their product portfolios, reducing minimum crediting rates on products, to reflect the prolonged interest rate environment that they were now in. This could ultimately lead to disintermediation risk if rates were to rise, both gradually and a little more severely if they rise more rapidly. There could be some asset liability mismatches as well. The industry as a whole in aggregate has lengthened their bond portfolio duration to the longest that it's been in nearly 17 years. Similarly, the proportion of bonds that are maturing in less than 5 years are also at the lowest point that they've been in close to 2 decades. Circling back on the liability side, annuities lacking surrender protection are also at one of their highest points that they've been in quite some time. So you have the combination of lower guaranteed crediting rates on a larger proportion of account values. You have leading to the possibility of greater disintermediation risk. You have potential ALM mismatching with lengthening bond portfolios and a lack of surrender charge protection. So those 3 factors in combination will likely provide some challenges to life insurers going forward.
Meg, could U.S. monetary policy have an impact on yields over the coming months or year?
Yeah, I mean, definitely. There's a number of factors that are going to go into, obviously, the yield curve and what we're seeing. Monetary policy will play a major role. They're looking for 2 to 3 rate hikes, as I said, this year, which has been well telegraphed to the market. And assuming that the economic data remains on track, should not cause any disruptions. In addition, the Federal Reserve has announced that they are, or has began in the fall, unwinding some of their asset purchases that they did during quantitative easing, allowing a small portion of their asset-backed securities and their treasuries to roll off every month without reinvesting the proceeds. So this is putting more supply into the market. In addition, fiscal policy, we really need to keep an eye on. with the budget that has been recently passed, that could be actually inflationary due to the fiscal spending. It's much broader than we have seen in the past, as well as the tax cuts. They could also be more inflationary. But as a result, the Federal Reserve, or the Treasury, is going to have to issue more treasuries this year, a lot more supply coming into the market. So as the supply comes in, we think that it's being digested very well right now, but over time, you might be able to see rates move up a bit. But obviously, it ties into inflation expectations. Right now, investors are not pricing in any sort of rate or any inflation increases. So we've seen a very flat yield curve. If inflation expectations do change, you could see that start to steepen in the coming months, maybe in the second half of the year. But obviously, very data-driven.
Jason, is there any concern over how policyholders might react should we see a rise in rates?
Well, that's definitely obviously a concern. If rates rise, policyholders that are in products that are very interest sensitive, thinking if CD rates rise, you'd likely see those policyholders leave their annuity policies to those other types of competing products with higher rates. Those higher rates will also likely stress lapse ratios. For insurers with minimum surrender charge protection or unfavorable annuity living benefit type options, those policyholders might be the first to leave. So if there's any type of exodus along those lines, that could potentially force insurers to realize losses on their bond portfolios, which could potentially be exacerbated if they have liquidity or certain types of cash flow issues as well.
How should insurers respond if there is a sudden increase in rates, and is there anything that they should be doing right now?
Well, you have to think that rates are going to rise eventually at some point, right? I mean, it's going to happen eventually. The question is when, how quick, and how extreme, right? So we have seen some insurers developing or already have developed annuities to kind of benefit policyholders in that rising interest rate environment. We have seen riders that allow policyholders to adjust their crediting rate. Once we have seen crediting rates to policyholders that could be changed on the contract anniversary date that are pegged to the 3-month LIBOR. And we have seen features that kind of regulate bond duration, which kind of pegs performance to both a bond index and an equity index to kind of mitigate some of that market volatility risk. But ultimately, insurers with well-established and effective ALM programs are going to be the most likely to be able to navigate through a rapidly rising rate environment. And further, insurers that use sophisticated ERM techniques will likely be able to be more enhanced in terms of monitoring their ALM positions through cash flow analysis, bond durations, earnings, convexity, and earnings and capital at risk.
Thanks, Jason. Thanks, Meg.
Thanks, Sean.
You can find Jason Hopper and Meg Mulry's full report online at ambest.com. For AM Best TV, I'm John Weber.